Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and I have Michael Corcelli on the line. He's Chief Investment Officer for Alexander Alternative Capital. Michael, how you doing on this volatile Friday morning?
Oh, very, very good. Nothing different than what we expected here.
Okay, all right. And what you're expecting some weak numbers or weak market? What were you expecting?
We're expecting confusion. Last year when we created our outlook for 2015, we knew that volatility was going to basically play an important role moving forward. And sure enough, as we have been, pounding on the drums all year, volatility is definitely driving the tape, especially for the last 3 months or so.
All right. So were you able to move into more of a cash position, or just adjust your portfolios to accommodate the volatility?
Yeah, coming into the end of last year, we've seen this increased volatility. So the way that we handle it more than anything is we raise cash, and we raise cash levels substantially, rather than going contrary to our macro outlook, which is bullish. When we get into uncertain times, we just basically stick with our highest conviction positions, and we raise cash levels substantially and wait for better buying prices to get back into the market and take some more risk. And sure enough, that has paid off this year.
So tell us about Alexander Alternative Group, long, short, equity, global macro, event driven. Tell us about your fund.
Sure, absolutely. So we start with a global macro top-down view. We a very big picture that isn't really much use on a day-to-day basis to trade off of, unless you're actually managing a portfolio of positions and looking to add into your convictions, or take some risk off to wait for the market to catch on to the view. Once we have a top-down macro view, and we have clearly defined growth drivers for growth, and we have risk factors, things to look out for, we start to construct a highly concentrated book of positions using bottom-up, fundamental value type research, and we go long and short. However, I've been very cautious about shorting this market. It's for us anyway. We don't like to play the short market except for when we're going into a recession, like a global recession. And even though it may be tempting, and there may be ways to pick up some additional, returns by shorting specific stocks that we know are going to go down, we'd rather just wait for better prices to go long. Now, if there's a major hiccup that's coming in the market, which this whole situation with China over the summer definitely starts to ring the bells of a looking more like a global recession on the horizon than the past 5 years and what's been going on globally. So I'm just getting to the point now where I believe that it may be time to really start aggressively shorting this market, but we are not in that camp yet. We're still believing in the growth story, and even though today was a bad non-farm payroll number, there was no wage inflation. The numbers were revised down from last month, and this number came in much weaker than expected, providing a backdrop for the Federal Reserve's thinking and decision in September. We believe that the growth story is intact. There's over 2 billion new consumers that have been let into the worldwide economy, and we just need to see some of the low commodity prices, low raw materials, cheaper Chinese goods, and the impact on consumption, which there's been a little bit of a lag. I'll admit, but we believe in that story, and we're gonna stick to it. And right now, we got a yellow light with the story, but that's why we're heavier in cash positions today than we have been in a very long time.
You said your superior returns are a function of superior idea generation and asymmetrical trade expression. Could you explain that to us, please?
Sure. We look we look first with this macro view, and then we couple that by building the portfolio bottom up using very fundamental value-based research. And once we have a good idea, then we start to go into the systematic trade expression and risk management side of building the portfolio. So we like to use options in our strategy. We have to have certain risk-reward profiles. It may be a great idea. It may be a great idea macro. It may be a great idea fundamental bottom up. But if we're not going to make 3 times the amount of capital at risk, we just simply will just keep monitoring an idea. So when we structure our portfolio, we structure it for an asymmetrical return given the amount of capital we put at risk, and that number is 3 to 1.
Mm-hmm.
We do use options too. We buy and sell options on large cap, medium cap, and small cap stocks, and it's not naked, so we're not selling naked options. We are using strategies that are covered.
Okay. We were talking before we got on the line. You were talking a little bit about the oil sector and the pipelines and transportation a little bit. Do you want to touch on the oil sector first and what you're looking at here for some possible setups?
Yeah, absolutely. The oil space is the energy space is definitely one of the top 3 most interesting spaces coming into 2015. We have put together a strategy to act more like a toll booth rather than taking directional risk on the underlying commodity. However, we have had a price target of $33 a barrel for crude oil and $2.50 a contract on natural gas. And the downward trend is a result of a supply-demand imbalance. There's just simply too much supply coming into 2015. There's too much supply right now, and we're going into a period when the refiners they take down some of the plants and basically do some maintenance work on them. So that just tends to exacerbate, from a seasonality perspective, the supply-demand imbalance. So we continue to see downward pressure in oil prices going forward, and we see those numbers down into 33, and a bearish case for us, believe it or not, is $25 a barrel crude. That's on a supply-demand equation. We're also, I guess, looking at a little bit of a demand slowdown here as well, and increasing production from OPEC members to meet their balances. Iran coming back into the equation with regards to new supply on the Iranian nuclear deal. So it's just it's more pricing pressure. The other side of the equation is the rigs that were taken offline in the U.S. They made significant cutbacks on capex, and most of the major E&P companies are not starting any new exploration projects, and we're at 2009 lows for Baker Hughes, and we see that providing more of support to oil prices in 2016. But clearly there has to be more pain in the space.
Mm-hmm.
The small cap E&P players have been absolutely 100% decimated. I wouldn't look towards those stocks to actually short. The mid-cap stocks have also been pretty much decimated. And some of the smaller large caps are now more like mid caps, and some of the larger cap E&P players, you'll probably be able to still find a little bit more room on the short side. Energy service companies, they're going to be weak through 2016. That's the general consensus. And the midstream assets, downstream assets, is the place to be in energy. You want to look at midstream assets. You want to look at downstream refining assets if you're really going to make some money.
Okay, so a little bit early to step into the oil patch here, and so we'll keep an eye on that. Gold market here getting a nice boost today. Any comments? I mean, it's supposed to go up when there's a little bit of turmoil in the market, long-term bear market. Any interest in the gold market?
Yeah, I mean that's not really a big one for us. We actually we follow it, and recently the turmoil has not been driving the price higher, although it has had a little bit of a bid here, with the bad news. But there's been days where there's bad news, and you would expect gold to rally, and gold finishes the day flat or slightly down. I think from the non-farm payrolls, if you looked at the numbers pre-release and after release, with this weak number, bad news is bad news right now, and good news is good news. And I think that is the first time, and as long as I seem to be able to remember, where bad news is bad news, and the market doesn't rally on bad news, and good news is good news, and the market rallies. So the street was looking for 175,000 jobs to 275,000 jobs this morning, and with this weak print, you've seen over 30 handle sell-off in the S&P futures, which is quite significant. Euro dollars, spiked on the news. The 10-year Treasury rallied on the news over a point, and it's just. It's what you would expect given the actual data.
Yeah, it is, and the S&P futures continue to go lower here. We just made a new low at 1983 and a quarter. We've been on the line with Michael Corcelli. He's Chief Investment Officer for Alexander Alternative Capital, a long-short equity fund. Great information, Mike. We will keep an eye on the markets you discussed, and we hope to have you on again soon.
Joel, thank you very much. Have a great day. Good luck today.
All right, thank you.